By nature, business owners, they're used to calling the shots. They're the boss. They answer to themselves at the end of the day. And suddenly, if they're reporting to somebody else, that's a whole different can of worms to begin with. And especially if their business is acquired by a larger company. And remember, I said I spent 35 years as that buyer buying those kinds of businesses and working through transition agreements with those sellers of those companies. And I've dealt with many of those scenarios where those business owners they just can't handle it.
Hey, it's the Profit Answer Man, Rocky Lalvani. If you're new to the podcast, check out my interview with Mike Michalowicz. It's episode number 2. If you want to hear about each chapter in the Profit First book, go back and listen to episodes 3 through 13. Episode 1 is the why and how. On the Profit Answer Man, we learn money mastery without all the complicated accounting mumbo-jumbo using a simple system. Your accountant is busy documenting your transactions and creating a rearview mirror of what happened. My guess is you don't even look at the reports they sent you. If you're like most business owners, you struggle with this. And it's not your fault. We aren't taught money in school, and accountants aren't taught how to be profitable. The Profit First system created by Mike Michalowicz works, and he certified me to help you implement the system in your business. Remember, the new equation is sales minus profit equals expenses. Let's face it, without cash flow, you can't pay your employees, buy needed materials, or pay your mortgage and support your family. I help you to do that and more, so you can focus on the parts of the business you love and receive the rewards for your labor and investment into your business. The stronger you are as a business owner, the more jobs you create, the better we are as a country. Small business owners are the backbone of America, and for that, you deserve to be well rewarded. Just remember, more revenue does not equal more profit. That's why we focus on the bottom line. I don't care if you want to sell your business. Building a sellable business makes the business more fun, more bankable, more lendable, and more profitable. Plus, if you choose to exit or you get a jackpot offer, you're ready to roll. One key is having someone like me to ensure you are financially viable and you can answer those buyers' questions, or your bankers. We chat about that and more in today's episode. Cameron Bishop is a seasoned executive and entrepreneur with a proven track record of driving exceptional growth and transformation across diverse industries. He began his career in publishing, culminating in his leadership of Intertech Publishing, where he scaled the company from a small business to a $400 million enterprise with a global footprint. Subsequently, he's co-founded Ascend Media, a high-growth media company, demonstrating his entrepreneurial acumen and ability to build successful organizations from the ground up. Now he's working to empower business leaders to achieve their full potential as they decide to exit or continue to grow their businesses. Let's meet him and learn how. Welcome to the Profit Answer Man, Cameron Bishop. It's great to have you join us today.
Thank you. Great to be here.
And I am excited for the conversation because always it's my favorite subject, how to have more profit and more cash flow. So can you share a little bit about yourself and your current business?
Absolutely. Be glad to. Yeah, I've a bit of an unusual career path. I actually started my career with a journalism degree and started as a copywriter in a company that was then sold. And the buyers of the company said, hey, we really like this business. We want you to go buy more companies. So it was like dropping a 6-month-old baby in a swimming pool and say, swim. We just went out and started making acquisitions. Over the years, we grew the business from $7 million in revenue to ultimately, when I finally left the company, we were doing $400 million and throwing off about $100 million in EBITDA profit. So Over that time period, I was on the buy side, acquiring probably 35 to 40 businesses. Left, wrote a business plan, partnered with JP Morgan Chase Bank's private equity division, and we built another company, did another 7 or 8 acquisitions, and grew that in about 5 years to 120 million. Spent 5 years as an exit and transition planning consultant. Did a 3-year engagement to do a very difficult turnaround on a $60 million 501c3. Got bored during COVID and decided I would go into investment banking because I like buying and selling companies. And that's what I do today.
Awesome. So I'm guessing buying companies is easier than selling companies. Or maybe not.
Well, generally, that is definitely the case. It's interesting, though, either as a buyer or a seller, it's an extremely difficult process. And people really don't understand that. On the buy side, I estimated to get one deal done, I looked at somewhere between 35 and 50 deal opportunities. And then, of course, the transaction cycle process, if you're lucky, you can get it done in 9 months, either as the buyer or as the seller.
Why is there such a low hit ratio to buying a company?
Well, there are a lot of factors. You usually as a buyer have a specific set of criteria, an investment thesis. So you're pretty targeted on what you're looking for. And even within the parameters that you're looking for, a lot of those businesses aren't truly viable, or they have so many difficulties inside the company that it's going to make it a very risky proposition to make that acquisition. There could be huge differences in corporate culture and management styles between the firms. Any of those can be a factor in the process. And then you're almost always in a competitive environment where other people are bidding on the same company, and you're dealing with a combination of total amounts you're going to pay for it, how you're going to structure the deal, what legal terms are going to be involved, whether the seller is going to stay on board or not. So there's a lot of intricacies that can get in the way. And frankly, most deals die not because of the price, but because of technicalities and legal factors in the negotiating process.
And I would assume that most people who are selling their business haven't done it many times. Like they're kind of like you talked about at the beginning, throwing the baby into the bathwater and saying, learn to swim.
Yeah, that's very true. It's interesting in the world as an investment banker today, and our firm, Raincatcher, we focus on what's called the lower middle market. So those are businesses that have, generally speaking, $1 million in EBITDA minimum, up to around anywhere from 6 to 10 million. And that is a very underserved market today because the Main Street business brokers, the vast majority, aren't experienced in deals of that size. And the larger investment banks, those deals are too small for them. So that focus group, those business owners, by and large, have not bought and sold other companies. It's going to be the single most important wealth generating factor in their lives. And it usually means for future generations and their families as well. And they have no idea how to do it. And it's very complex. And they think it's no different than selling the product or service that they sell. And it's wildly different than their day-to-day business.
And on the sell side, I'm guessing, and people don't realize this, most businesses aren't sellable, are they?
No, they're not. I think it was Pepperdine's business school. I think they have a specialty in small business academics or something to that effect. And the common statistic is that about 70% of companies that are up for sale never sell. And only about 30% of companies successfully transition from generation 1 to generation 2 ownership, and only about 10% successfully transition from Gen 2 to Gen 3. So the odds are against most business owners.
So what is it that makes a business sellable versus unsellable?
Yeah, so we have a lot of business owners call us or email us or contact us on our website because they're thinking about selling. The first question we always ask them is a personal question. That is, why are you thinking about selling? And there's a whole variety of reasons for that today. And the dynamics of that answer have changed dramatically since COVID. Pre-COVID, most business owners said, well, I want to play golf. I want to play more golf, or I want to travel. I want to spend time with my grandkids. My spouse, I want to spend more time with him or her, or they've had an illness. I need to focus more on them. Post-COVID, the dynamics changed a lot. Many business owners, they were beat up during the steep recession in kind of '07 to '09 time period. So that took a lot out of them. They had to recover from that. COVID took a lot out of them. Then they had to battle supply chain issues and rapid pricing increases and limited inventory access post-COVID. But more importantly, a lot of them, they're worn out from trying to find people to hire, hiring people and having them not show up for a week or so and then ghost them. It's become very frustrating for a lot of business owners, and it's restraining, in most cases, their ability to actually continue to grow their business. So they're just kind of tired. A lot of them are frustrated. So that's a big factor in their motivation to sell.
Out of curiosity, what are you seeing in the economy now as far as kind of where are we at in this cycle? Because this has been the weirdest cycle ever.
Yeah, we've been through some roller coasters of what I would broadly define as uncertainty. So, of course, during the COVID period, everything was an anomaly. Coming right out of COVID, there was real pent-up demand in the mergers and acquisitions world because they weren't getting deals done during COVID. So there was a frenzy, and many business owners benefited from that timing. So you could consider that probably a macroeconomic factor that benefited businesses versus, industry specific or micro based factors. But then interest rates began to rise. We had some major bank failures. Those interjected a significant amount of uncertainty into the markets. Credit started to tighten up when buyers were going to put a debt facility in place. That began to impact things. Then, of course, there were fears around recessions. People became hesitant based on whether or not there was going to be a recession. And then, obviously, the interest rate spike took off. The bank credit requirements got even more difficult. So all of those have been significant constraints on the markets overall. Now, in the existing political environment, whether you agree or disagree with the actions that are going on today is not so much the factor as it is the amount of change that is introducing into the marketplaces and the correlating uncertainties around that. We're hearing from everybody we talk to these days, fears around all of the factors related to taxing incoming goods from China, Mexico, Canada, et cetera, and how those are going to impact their businesses and their profit margins. So yeah, overall, an uncertainty or unknown is definitely kind of a macro factor, thematic, no matter what industry you're talking about.
Have you noticed that some companies are better at finding, recruiting, and keeping people than others? And if so, what's that secret sauce?
Well, there are certainly some businesses, and it's more of a industry-related thing oftentimes. If it's a glamour type business where people really want to work in that kind of a business, that could be a case. Or if the company has a tremendous market, say if it's a geographic or city specific, or even better if it's national in terms of whatever it is, their benefits or the culture of the environment. Those can be factors. But Rocky, broadly speaking, it doesn't matter what kind of industry we're talking about. I hear the same thing thematically about business owners not being able to find and or keep employees, no matter how generous their programs are and how competitive they are on compensation packages. It's just a broad-based theme today.
Hopefully that corrects at some point.
Yeah.
And that's that is one purpose of a recession, is to reset expectations and take the excess out of the market so that we kind of get back to a bit of reality. So What is it that makes a business more sellable versus a business that's not sellable?
Yeah, I'll run through a few of the key criteria. The first one, I think, is a fractional CFO, Rocky. It's going to be music to your ears. And that is that it's staggering how many business owners have just horrible financial reporting, if they have any financial reporting at all. If they do have it, a lot of them are fortunate enough that they're throwing off enough cash that they have the luxury of not really tracking their financials carefully. And they do what I refer to as simply checkbook accounting. They've got enough cash, they get a bill, they look in their bank account, and if they got money there, they pay the bill. If they use QuickBooks, they're almost always a cash basis only versus truly GAAP accrual basis. And almost all buyers and banks that are going to back a business when a buyer is going to buy it, they need to see accrual based numbers. They need to see balance sheets. Sometimes they need to see cash flow statements. Most business owners don't even know what those are. And if I talk to one and I say, well, do you have accounting? And if they do say yes, I said, okay, are you on a cash basis or accrual basis? I'd say 6 in 10 don't even know the answer to that question. So that means that by and large, they're not, again, you as a strategic fractional CFO often teach them how to use their financials as a planning tool for strategy in their own companies. And that means actually that they have to work on their business and not just work in their business. And I would say 95% plus time of business owners is simply spent working in the business and not focused on working on the business to drive value creation. And they don't even really understand the difference between factors around value creation versus running their business for income tax avoidance and throwing off an annual distribution, because most of them are pass-through entities, S corps, LLCs. So we just see tons of that problems around accounting. I'll give you a really quick example. It's a sad story. Had a husband and wife business owner approach us, had a really nice company in the automotive aftermarket test equipment, which is a hot category where other companies are buying those kinds of companies. And again, I asked them why they wanted to sell, and they didn't want to run the business anymore. And then I said, what are your financials? They told me, well, we did 6 million top line revenue and we did 1.4 million in EBITDA. And I said, wow, that's a great business. This is going to be a very successful sale. I said, next step, we sign an NDA for them. They send us all their financials. One of the partners that works with me he's a licensed CPA, spent 15 years in audit practice at KPMG. So he goes through the numbers with a fine tooth comb, restates them on an accrual basis. And it turns out they were not booking entries around work in progress or raw goods inventory. And when the numbers were finally worked out, not only were they not making $1.4 million as they thought they were quite literally a break-even company. And it's an extreme example, but that's a true case that came to us that we had to work through. That those business owners still own the company, are trying to recover and get their company into a sellable position. They've been working at that now for another 2.5 years since we first met them.
Why do you think so many business owners are allergic to the financials?
I think mostly because they don't understand them. They don't understand how important they are. They're oftentimes very good at what they do, which is why they can often be successful. Another real quick example, I represented an incredibly talented lady who owned the largest video production company in the Midwest. And she won national awards that was doing national video commercials and campaigns for major American companies. But she didn't have a clue about her financials, and she called me in just before she was about to go bankrupt because she didn't know her accounting. She was spending money where she shouldn't be. Thankfully, that had a happier ending. I brought in a fractional CFO. We completely reworked the numbers, put together sales pipelines for her, and ultimately got her a reasonable exit for her business, which would not have otherwise happened. But she was a creative genius, but she was successful for 20 plus years, kind of in spite of herself. She just generated a lot of money from her talents, never really paid attention to the numbers.
We see it all the time.
Yeah, we do. Every day.
That's what, it's funny. That's what people show up and they're like, and I asked to look at their numbers and they're like, oh, they're horrible. I go, trust me. If they weren't horrible, you wouldn't be here. That's how everyone shows up at my doorstep.
Yeah.
It's okay. That's the problem we fix. So besides numbers, what else makes a business sellable?
So there are a few key factors that are obviously the inverse is what makes them sellable. So I'll approach it from the things that don't make them sellable. Next to bad accounting, probably next is owner dependency. So we see a tremendous number of cases where the business owner, he or she is either the sole or primary keeper of all knowledge in the company, especially if it's technically related information. Buyers, ironically, are two-sided, so they're willing to take risk in buying a business, but at the same time, they're extremely risk averse. So a risk averse factor is if a company is highly dependent on the owner and there are no successors underneath them that have key market or industry knowledge. If that business owner is also the primary contact for customers, that's another big time red flag for business owners and for buyers. Most business owners, they have, when they decide to sell in a reasonable period of time and some immediately, they want to exit. But buyers, they either won't buy the business if that owner is going to exit, there is that much dependency on them, or they're going to require that seller to stay on for some kind of a negotiated period of time, which is anywhere from 1 year to 5 years, depending on the situation. So having a succession plan, number two in place, or not being the sole keeper of all customer relationships and technical business acumen are key factors for sellability.
How does that usually work out? What I have seen is when a business owner stays on and now they're an employee or a consultant, they're no longer in charge. And it's a dramatic shift in how they're treated and expectations. And I usually find it doesn't go great for the person who has sold the business to have to now, especially if they have to stay and work. Am I generalizing or have you found it to be better?
Rocky, in the majority of cases, you are spot on with your assessment there. Yeah. I mean, by nature, business owners, they're used to calling the shots. They're the boss. They answer to themselves at the end of the day. And suddenly, if they're reporting to somebody else, that's a whole different can of worms to begin with. And especially if their business is acquired by a larger company. And remember, I said I spent 35 years as that buyer buying those kinds of businesses and working through transition agreements with those sellers of those companies. And I've dealt with many of those scenarios where those business owners, they just can't handle it. And part of that is there's two other factors there. One, when a larger company buys, they're going to come in to a smaller business they've acquired and introduce all kinds of systems and processes and procedures and accountability and reporting requirements that a smaller business simply isn't used to dealing with. Secondly, again, another case study of a business I bought. We kept the owner of a business we acquired in New York, paid her about $7 to $8 million for her business, so she did very well. And she, to her credit, had a very strong number two manager in her firm. We identified that individual as extremely talented, promoted her to the top job. So suddenly the former owner is now reporting to somebody who used to report to her. And in many regards was doing a better job at the job than the former owner was. And it became a fractious and untenable situation. And we had to go through a very difficult negotiation and buy her out, her transition agreement, because she was disrupting the entire employee population. And those employees also had formed sort of a resentment against her, that former owner, because they knew she made a ton of money and she didn't pass the hat at all. So they didn't see any of those gains, even though they felt like they played an important role in the value creation there. So there's a lot of human dynamics that go on around these transition factors.
There are a ton of them. So we've got to be financially savvy, and we've got to get the hell out of the way in running our business, which means we need to be a business, not in the business, but managing from the outside of the business. And you know, those two things are tied together, because a good CFO creates a dashboard for the owner to be able to run his business, look at a handful of numbers, go thumbs up, thumbs down. What are you going to fix when we give you the thumbs down, and have it in control? And so I get that. What else makes a business more sellable?
And so the next thing is not to have what is referred to as exceptional customer concentration. So in the world, so any of these companies, million, 2 million in EBITDA on up, a lot of them are being acquired by financial buyers like private equity firms, or what are referred to as independent sponsors, or search funds, or even some family offices. And when those kinds of buyers call us to ask us about a business that we're selling, the first or second question, they're going to assume that the financials are in order because we've already presented those, so they know that's a factor. They're going to ask us, question number one is going to be, why is the owner selling? What does the owner want to do? And what role does the owner play in the business? Question number three is going to be, how much customer concentration do they have? So the litmus test is generally 20%. So if a business has 20% or more of its revenue dependent on one customer, that's going to be an automatic disqualifying factor for probably 80 to 90% of financial buyers, because they don't want the risk of losing that one large client. They'll even look at what are the top two or three together, but certainly the minimum threshold is they don't want to see a business with more than 20% of revenues dependent on one client. So those are your top three. Number four would be, they don't want to see overdependence on an individual supplier, where if that supplier left them or went out of business, that company could be in big time trouble if there weren't alternatives to a key, usually raw materials or raw goods supplier for the business.
Are those the big four? Any others? Or
yeah, then from there you get into, and it varies by type of industry. They're going to want to look at what gross profit margin percentages are, because there are minimum thresholds. For example, we sell a fair number of distribution type companies, value added distribution, fair number of them in construction related industries. Almost always they don't want to look at a business like that if it's under a 10% gross profit margin type of, or excuse me, 30% gross profit margin, 10% EBITDA margin kind of a business. So that varies by industry, but maintaining sort of benchmark level profit margins at gross level and at EBITDA level, they're going to be measured against those factors.
And I will say, if you've got a 30% gross margin, unless you've got really high revenue, it's going to be hard to have a 10% profit margin at the end of the day. That's what we found. We found if you're at 30 or less, you're struggling unless you've got a business that just doesn't require overhead. Like no big marketing, not a lot of people. It's fairly automated. Otherwise, you can't run at those kinds of margins, and it's just too difficult. And they're always struggling with cash flow and tightness. And even at a 10% margin, I always say 10%, one or two bad months, and you're in trouble when you're running that tight. And so we like to see bigger margins and just for sustainability reasons.
Yeah. Yeah. The margin of error is slim. And that's why those deals either get heavily discounted in terms of what a buyer is willing to pay, or they won't buy at all, or they will structure very different deal terms if they are going to move forward with the acquisition to hedge against the risk related to that kind of a deal.
Now, I know in certain industries, some people will go in and actually buy bad margins, but they'll do it because they understand how the business should work and they know they can buy that business for cheap and they know how to fix it. Now, most of those I would probably say tend to be in the franchise space because it's a systematized business and they know, oh, this particular owner's not running it well, doesn't know how to take care of these things. We can usually fix it and then pick up margin. But I'm guessing in the regular world of business, that isn't always the case.
Yeah, that's generally not the case. We do see it on occasion occur. For example, as I mentioned, I used to do leverage roll-ups for private equity. Did that in the media and information industry sectors. So what we could do is we could look at a business, and again, smaller businesses are generally by nature far less efficient. They have to have headcount on a smaller base of revenue and employee population. So when a larger company acquires them, they can usually extract additional savings from back office redundancies, blending that company in with the larger purchasing power for raw materials that the bigger company has, and they can build up those margins. And they know that going in because they know that kind of a business inside and out, and they factor that into their thinking and what they're going to pay. In our case, if we were going to pay a buyer or seller of a business 6 times their adjusted EBITDA, we'd already done all of our homework and we knew that probably our net effective multiple on that deal after consolidation savings and efficiencies on pricing, et cetera, we were going to probably be at a realized 4.5 multiple. So we could knock, a point to a point and a half off the effective multiple of the deal by extracting those efficiencies on consolidation.
Now, a lot of business owners get excited by PE. And a lot of times PE will come in and buy a portion of the business. So they'll take a ownership stake. A lot of times I find that's not much different than when the business owner has to stay after the sale. It gets contentious. And it's funny because I think the owners think, oh, well, we're going to get all this capital infusion and all of this. But I don't think they're used to having to deal with the other side of that coin. I don't know if you've been involved in situations like that and how they tend to turn out.
Yeah, I've been on both sides of that coin. And most of the deals we see in this lower middle market today, again, I say our minimum threshold is $1 million, but most of our clients are $2 million to kind of $6 million. That's the real sweet spot. And that's in a very attractive market for private equity right now because competition has been so great on larger businesses that many of them have kind of come what we refer to as down market. And they'll acquire a group of these kinds of companies and put them together and aggregate them as a much larger company as part of their overall financial play. And deal terms today, and again, earlier on in our call here, Rocky, I mentioned, factors around interest rates, banks clamping down on the amount of leverage they're willing to agree to on lending money. And the private equity guys don't want to put any more equity in than they have to. So that is reflected in their deal structure proposals. Usually we're seeing them ask for the owners to stay on board for a negotiated period of time and roll over 20% of their ownership stake into equity in the new legal entity as they stay on board. And that's it's the general term for that is referred to as the owners get to take a second bite of the apple. So if they stay on board and the private equity guys or family offices, whoever it might be, execute on their strategy to acquire multiple businesses and build a much larger business. Their typical hold period is usually, if they're fast, they can flip it and sell it in 3 years. More often it's 5 years, sometimes 7 years. A few have a longer view, maybe a 10-year hold. But when they flip it, the theory is they get what's called an arbitrage on the exit multiple. So if they paid an average of 6 times EBITDA for all the businesses they bought, build a much bigger business, then they can sell it at an 8 times multiple or whatever the actual numbers might be. And that business owner, oftentimes, when those scenarios work, it's a beautiful thing, and they can often make more money on the 20% of the business they retained and rolled over than they made on the 80% of the business they sell. But all of these scenarios have risk, and they don't all always work.
They don't. There's always uncertainty in the market. Is there anything we should have talked about but didn't get a chance to?
Yeah, there's I'll help with a couple of expectations for these business owners who are going to sell. And we often joke at our firm that everybody thinks investment bankers are just about dollars and cents and numbers and being hardcore negotiators. And there's truth in that. But I would say that about 50% of the job is what I refer to as a combination of Dr. Phil work and Match.com. So on the Dr. Phil side, business owners need to understand that if they're fortunate, if they signed an agreement, an engagement agreement with a broker or an investment banker, they need to count on, as they look at their own personal timeline, it's going to take at least 9 months to sell that company before a wire transfer hits their bank account. And that's assuming it becomes a successful sale.
Thank you so much for joining us today. Are you the bottleneck in your business? If so, it's worth a lot less. Can you explain your numbers? And do you have the margins needed to command a good valuation? If not, that's the problem we solve. More cash in your pocket. Work less, make more. That's my mantra. That's why we created the new Profit Blueprint book that's available for free on the website, profitcomesfirst.com. You don't even have to pay for it. You don't even need more resources. You need to be more resourceful, which is what we teach you in the book. Remember to focus on the bottom line.
If you'd like for us to be a part of your profitability journey, we have different programs available ranging from do-it-yourself to one-on-one coaching. Our course, The Profit Blueprint, teaches you everything you need to know to transform your profitability. There are 3 different tiers ranging from DIY to done with you so that businesses of all sizes can get the support that's best. Join the waitlist in the show notes to get more information and be a part of the next cohort. If you want a done-for-you service, you can hire us as your Chief Profitability Officers. We only work with a handful of clients, so they all get our full attention. We work with business owners who have or are growing to $500,000 to $10 million in revenue. You can use the scheduling link in the show notes to get on our calendar for a good fit conversation to see if we're the right people to support you and how we can help you.
Remember to check out my other podcast, Richer Soul, where we talk about how to live the ultimate life and be the best business owner you can be. As we close out, let's repeat the mantra. Revenue is vanity, profit is sanity, and cash is king. Have an abundant and profitable week.